everybody, and welcome to the Equity Mates Media Tent. Hope you've all had an awesome day so far. Thank you for sticking around this late. Hopefully you're still enjoying everything. I am Maddie. I am one of the podcast hosts, or a co-host of Your Own Good Company, which is in the Equity Mates Media Network. And we are here in this tent this afternoon to talk all things ESG. So it can be a pretty confusing, can be a pretty confusing topic. You've got Elon Musk saying ESG is fraud. You've got different acronyms. You've got people telling you that it means something different to everyone. So here to unpack all of that and more, we've got these guys with us today from Perennial. But before we get there, I do have to read the disclosure, which I'm sure you've all heard plenty of times already today. So all of the information presented today is for educational and entertainment purposes only. Any advice is general advice and is not taken into account your personal financial situation, circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you are unsure, speak to a financial professional. And as of earlier this week, very exciting, Equity Mates Media operates under the Australian Financial Services Licence 540697. So let's get into it without further ado. Please put your hands together for Maddie and George.
Thanks for the introduction, Maddie. So hi everyone, and thank you so much for joining us here today. I'm Maddie Huynh, and I'm an ESG analyst and assistant equities analyst at Perennial Better Future, working with George. Before we begin today, I'd first like to acknowledge the traditional owners of the land on which we're gathered here today, the Gadigal people of the Eora Nation, and I pay my deep respects to their elders, past, present, and emerging.
Can everyone hear me? It's all good? Great. I suppose to kick off, can we maybe just get a show of hands as to people who are familiar maybe with sustainable investing, maybe use sustainable products? Okay, so pretty...
Love the enthusiasm.
Yeah, love it. That's great. So by way of introduction, my name's George Whiting. I'm head of distribution for our sustainable strategies at Perennial. And I suppose what we do that's a little bit different to the market, we actually go out and try to find companies who are solving sustainability challenges. So we often see these in areas of renewable energy, healthcare, education, water and waste treatment, environmental outcomes, social outcomes, and these sorts of things. And I suppose as a little bit of context, it's been a rough patch over the last 6 or so months, but we fundamentally believe that there are really strong drivers behind sustainable investing. And that's why we keep doing it. These drivers are global. The number one driver is policy. Policy has been really, really accommodative for particularly renewable energy, but also things like buildings emission standards, water standards, environmental standards, modern slavery acts. And that really kind of paves the foundations for sustainable investing. And then on top of that, and this is where we really see the heartbeat of sustainable investing, and it's the technology. There's enormous amounts of technology going into solving these issues, decarbonising, resource efficiency. There's lots and lots and lots. The next one, which is a little bit less tangible, but cost of capital. And McKinsey recently did a study and found that companies with strong ESG metrics actually had a 10% lower cost of capital. And if you think about why, if companies are trying to raise money on equity markets and they're strong ESG performers, they're sustainable funds, then naturally there's kind of a bit of a demand. There's that ESG premium. Or if they're going to the bond market or going to the debt market, it kind of makes sense because, as we're going to explain, ESG is about risk mitigation, and ideally these companies have better risk return profiles. And the last one's consumer preference, and I think this is probably something that resonates with all of our cohort pretty well. But we don't want to buy products now that are made in sweatshops, and we don't want to buy we want to buy electric vehicles or organic food, organic wine. So there's been a really, really big push from the consumer as well. So with that in mind, we're not really going to talk about that. What we're going to talk about is first of all, we're going to cover the different spectrum, as you can see up there, of responsible investment. But the main thing that I hope you all take away today is we're going to explain what ESG is, and ESG as a risk mitigation tool, and why it has nothing or very little to do with sustainable investing. It has very little to do with the green agenda, ethical investing, feel good. ESG integration should be in every single portfolio. It doesn't matter about your moral compass. ESG in every single portfolio.
Yeah, definitely agree, George. Thank you. And I think just to touch on the strength of those 4 key drivers that George mentioned, a statistic that I love and read recently is that in every $3 of $10 in equities, that is being allocated to an ESG strategy. So ESG investing, it's not a niche anymore, and it's attracting large global flows of capital for good reason. There is an abundance of research that has shown that over most time periods and most asset classes, there is no performance trade-off when investing with an ESG lens. So I think to kick it off, George, what's ESG?
So what is ESG? And I spent the first part of this talk talking about sustainable investing. And if I can now, I suppose, decouple ESG and sustainable investing. ESG is best described as managing inputs. It's a company and managing the environmental, social and governance inputs that go into that company, right? So you might see, we recently saw on Twitter that Elon Musk kicked up a fuss because Tesla didn't have as good an ESG rating as one of the oil and gas companies, right? But if you kind of break down what ESG is, Tesla has, on the social and governance side, it scores really, really poorly, right? There's one guy at the top, sure, he's great, but there's one guy at the top, he makes all of the calls, the staff leave, the staff turnover is horrible. Sure, what his company is doing is sustainable, but on an ESG perspective, he doesn't score that well. Whereas if you look at an oil and gas company, not that we would ever invest in one, but if you look at an oil and gas company, sure, the E in ESG, the environmental, doesn't stack up all that well. But from an S perspective, they're all probably paid really, really well, right? They're all probably looked after really,
Strong retention rates.
Strong retention rates. They can manage their supply chains. From a governance perspective, if you pop the hood and look at the board on all of the global miners, global oil and gas companies, they're really, they're independent, entirely independent, and there's 50-50 as far as diversity goes. So they're really diverse. They look after their staff, really good governance, so they actually kind of score well.
And it's definitely the larger companies, like on that note, it's definitely the larger companies that typically have higher ESG scores from these third-party vendors because they have the resources to be, creating those sustainability policies and also, searching for non-executive directors from diverse backgrounds, etc., versus a smaller company.
So ESG analysis is about understanding the environmental, social and governance risks of the company, right? But sustainable investing is about the impact that company has on the real world. Is it solving a sustainability challenge? Is it decarbonising the world? Is it doing good things for society, blah, blah, blah. That's sustainable investing. And ESG is purely a risk mitigation tool. And that's why we fundamentally believe that it should be applied across every single portfolio.
Yeah, in addition to traditional fundamental research practices like, looking at key valuation metrics, balance sheet strength, cash flow generation, is there a sustained competitive advantage? Is there a positive market outlook that is a strong tailwind for that business? So ESG is essentially just bolted on to this traditional research process that has existed for a very long time as a risk mitigation tool. And I think George will agree with me when I say that there is definitely a misnomer in the market that ESG is this feel-good or greeny approach to investing when that's really not the case. It doesn't matter if you're ethically minded or not. For you to, that has little to do with whether you should be considering ESG factors in your portfolio. And I think, what we do at Perennial, outside of Perennial Better Future, really is a testament to that. We integrate it across all of our strategies, not just our dedicated ESG strategy.
So it might be helpful now to run through this spectrum, often quite confusing spectrum, of what exactly responsible investment is. But first we'll start with ESG, okay? So ESG, as I've said many times, is about understanding the risks of the external risks on a company, the non-financial risks on a company. The E is environmental. And again, if we take something like a BP, an oil and gas company, who, as I've said, probably has very good S&G, and using analysis, you would look at that and you'd go, okay, there's a risk there, there's an environmental risk there. BP had an oil spill in the Mexico Gulf, right? The share price got smashed. That's nothing that you're going to be able to find on the balance sheet or the profit and loss statement, but it's something you need to consider as an environmental risk.
Thanks, George. That's a good example of environmental, definitely a tangible example as well. Moving on to S, we have social. And in social, this is where we want to look at how is the company treating its workers and society. So is there a high employee turnover rate? If so, Why might that be the case? Does it have appropriate measures in place to mitigate modern slavery risks within its supply chain? What's the diversity like within the organisation at all levels, not just junior levels, but also at the executive and the board level? And then moving on to the G, that is the governance piece. And this includes various things that George has mentioned before, such as the independence of the board. Are the board members paying themselves too much potentially? Is the chairperson independent? And also, what's the gender and also ethnic composition of the board? Is there enough diversity there? At Perennial, we believe that boards, more gender diverse boards, definitely benefit from diversity of thought and experience. And there is a lot of research as well that shows the correlation between stronger board and executive gender diversity and our performance versus peers.
So I'd like to give you an example of a company that we invested in, and this is using ESG and sustainable investing. So we invested in a company called Cleanaway a number of years ago, which I'm sure some of you have heard of. So Cleanaway is a waste and resource recovery company, and from a sustainability perspective, it ticks the box, right? We have finite resources. We need to clean up. We need efficient waste management. It is kind of fits that sustainable investment theme. So we'd invested with them. We obviously did our research, did our ESG research. We had a position. We heard rumours that there was bullying inside the organisation. So we called a meeting with the Cleanaway board. They said no, it's fine. At an AGM, the CEO had a pay reduction. And again, we met with them and we said, hang on a minute, why are you reducing the pay of your CEO? Nothing, it was revenue based, it's not an issue. Bang, AFR article. So at this point, we sold 20% down because we thought, hang on a minute, something seems fishy. Again, this is nothing that you're going to find in the balance sheet or in the profit and loss statement. So we started selling down our position. We sold down 20%. AFR article came out. There was bullying, systematic bullying through the whole thing. We sold our position, stock was down 20%, right? That is all an example of risk mitigation within an ESG framework that needs to be considered. So why don't we move on to...
Thanks, George. The broad spectrum of the different types of ESG investing. So I'll start with ethical investment, which you might have also heard as negative screening. So this is basically the early incarnation of ESG within the investment sphere, and essentially involves negatively screening off the sin stock. So this could be implementing exclusions against companies operate with revenue exposure to tobacco, fossil fuels, alcohol, entertainment, and so on and so forth. Moving along one step, we have positive screens. So this is where fund managers and investors are typically tilting their portfolio to having holdings in industries and companies that have higher ESG scores. So these might be companies that have those higher ESG scores relative to their peers. Taking, for example, like how George was talking before about ESG, Tesla's ESG rating versus BP, et cetera. They're looking at those types of scores and seeing which ones would be higher relative to their industry peers and selecting those. But George is going to touch on the sustainable thematic, which is where Perennial Better Future operates.
So sustainable thematic, as I started the session with, is really tapping into the sustainability themes, and that's decarbonisation, investing in renewable energy or healthcare, education, water and waste treatment, social outcomes. It's really tapping into those themes. And I thought, what might be useful is giving another company example. So we invested in a company called Calix, and I don't know if any of you have heard of it. It's about $1 billion and a half market cap company. Wonderful Australian smaller innovator.
Very clever.
So global greenhouse gas emissions contribute to 9% of cement and lime manufacturing contributes to 9% of global greenhouse gas emissions. 9%. It's an incredibly pollutive industry. Now, if you look at the policy, and as I spoke about earlier, those drivers of sustainable investing, if you look at the policy, particularly in Europe, what's happening, and all of a sudden these companies in polluting industries need to transition to net zero by 2050. Okay? So how does a company that's spitting out CO2 and that's basically part of their manufacturing process. How do they do that? At the moment, the way to do it is by carbon credits. And carbon credits are traded on a daily market, and you get traders buying them. They're up 20%, down 20%, who knows what they're going to be in 2 years. It's not a sustainable business model. Well, Calyx has actually developed technology in-house in Australia that essentially they build a kiln and they trap every bit of CO2 in that cement and lime manufacturing process and strip it out. They can create carbon-free cement and lime. So they've signed agreements with Heidelberg Cement in Europe. Yep. They've signed with Tarmac in the UK. They've just signed with Adelaide Brighton. And this is a really good example of a wonderful smaller Australian company that's providing a product or a solution to a sustainability challenge. So yeah, there's a raft of...
there's a myriad of sectors that might have exposure to this sustainable theme. As George has mentioned before, for example, industries that we're exposed to in our fund might be renewable energy, healthcare and education, companies that are helping to drive stronger environmental and social outcomes, but also still, pursuing consistent returns at the same time. And moving one step further from that, we have impact investing. So impact investing is where the primary objective of your investment is to create a strong social, like a positive social or environmental outcome. And the difference here is that financial returns is typically ancillary. It's typically secondary to the key objective. I think one example, there are a few good examples of impact investing, but let's take the example of affordable housing. So you might be wanting to invest your money in an organization or a strategy or a fund that is going to be helping to build affordable housing to help overcome the housing challenges we have here in Australia and provide safe, secure, stable, affording housing for everyone. Another great example might be the provision of a loan, and this loan might be to fund the creation of a private healthcare clinic in a regional area that is going to supply affordable healthcare services within that area that didn't have it prior. So there we have impact investing, where the key objective is to really create that strong social outcome or environmental.
Do you think that's a DJ playing now? Has the DJ come on?
I think we're missing out, guys. I think I've got FOMO.
So I suppose what we need to, just in rounding this all out, I completely understand. I've been in the sustainable investing world for 8 years now, and I completely understand that some of these might not be for everyone. I believe that, and I believe that if people want to invest in oil and gas and tobacco and whatever, then they can do that. But what I don't believe is that no one should consider ESG as a risk mitigation tool. And that's the point of...
You should be considering it.
Sorry. Everyone should consider ESG.
No one should be discounting it as a risk mitigation tool that is key to every portfolio, because in essence, it really just helps you understand your company better. I think George gave a fantastic example about Cleanaway. Through engagement, you learn things, and through ESG research, you learn things that you're not going to find on the balance sheet and you're not going to find in a fundamental research process. And particularly with the very strong sustainable drivers we've got at the moment, this ESG research is becoming even more important. I think we've seen that here in Australia this year. That policy driver that George mentioned is key. We've got a new government in last month. We've seen a climate bill be introduced. Lots of companies are setting net zero targets, and so Australia has one now as well, 2050, as well as emissions reduction targets. So that really hones in the importance and the relevance of considering all of these factors, and that was an environment example.
We're quite short on time. That went a lot quicker than what we had rehearsed. Any questions?
We can do question time. Maddie, can we do question time? Guys, let's do question time. It's very exciting.
Any questions down here?
So is the company's ESG based on a universal definition, or like greenwashing, it's independent to the country and continent? Thank you.
Great question.
Yeah, that's a good question. And people, I think, tend to think that ESG from research providers or data providers needs to be the exact same. But I look at ESG research in the same way that I look at broker research. And different brokers have different price points on different companies, right? In the same way that we tend to score much more on what's called, we add another E, that's engagement. If we see companies engaging with us and they want to get better on ESG, they want to understand their risks and opportunities, then we give them a higher weighting. So it's horses for courses, and every fund manager does it differently and has different outcomes.
Sorry. Thanks, George. And I think on that point as well, ESG can, like, it's a very, it seems like very qualitative, right? It's very hard to measure some of these things, particularly in the social and governance sections, like environment. We can measure emissions, we can measure carbon revenue intensity, etc. It's important to note that while Perennial uses our own ESG scoring mechanism, third-party data vendors actually aren't even aggregated. Like some people might count something, gender diversity only in social when it's actually relevant to social and governance. Gender diversity matters in both facets. Or some people, so that's all not aggregated, which is why we prefer to score internally, and the engagement piece is particularly important because I think it's in those conversations with companies and getting to understand management, getting to understand how the board thinks on a very intimate level where you see information that you're not going to find anywhere else, and that's opportunity.
I actually have a question.
Go on.
As a retail investor, if I find a company that I'm really interested in investing in, I really like the look of it, how can I go about doing that extra step to try and identify whether it is ESG and it is going to align with my values? Where can I find that kind of information?
First starting point would probably be going to AGM, understanding what fund managers and what other investors have brought up.
Yeah, agreed.
There's things like, you can follow who's voting on what. The other thing is you can see which other funds are investing in it. There's often lots of literature. I mean, as I said, it's not necessarily in the annual report, but I think the AGM is probably the best place to start.
Good question, Maddie. It is
Good
tricky,
question.
and I'm sure I'm relatively new to the industry, but I'm sure that's something that's been tricky to navigate as well. And but I agree with George. AGM is
you could go to you could own one share and you can go to the AGM and sit and ask a question.
Yeah, you should go, Maddie. It's AGM season coming up. Strike.
An AGM annual general meeting, yeah?
Correct.
Any other questions?
Thanks for that, guys. I just want to ask whether returns from ESG, is it alpha or is it risk premium?
So it's horses, as I said, horses for courses. Very rarely do you find one fund manager doing the same thing as the other. RIA, who are the Responsible Investment Association Australasia, put together a massive report every year, and they do a benchmark of responsible investment. And while potentially in times like the last 6 months where the industry has seen headwinds, where oil and gas, which we wouldn't touch, and the industry is naturally underweight, has been one of the best performers, where healthcare is potentially out of favour, which we've seen healthcare come off over the last 6 months as well. So there's going to be times where it underperforms and overperforms. But what their latest benchmark said a number of months ago was that there is no there's no return compromise, that you don't compromise on returns, and often there is lower risk. If that answers your question.
No.
Any other questions? Yes.
What do you see happening to all the negative industries like oil and gas in the future?
That's a very good question. So from a starting point, we need to understand that, if we take tobacco, if we go maybe the extreme, and the theory is that tobacco kills people, right? You would naturally assume that an industry like that is going to face headwinds. What we've seen, I read a report only a few months ago with the large tobacco companies in the Western world. A lot of them have actually done very well over the last few years. But in the Western world, we see smoking rates decline. In the developing world, we're actually seeing smoking rates go up. So the theory is, Jasmine, that industries that are doing negative things should be facing headwinds. As far as oil and gas, it's a bit complicated and potentially controversial, but we need to be able to transition out away from what is a finite resource. Right? In Australia, we're very lucky because we export energy. We've got a lot of gas, we've got a lot of coal, we've got oil, and we've got potentially a lot of renewable availability. So we're very lucky, but there's a lot of countries that don't. China, for example, import 80% of their energy. All of a sudden, in a time like this where coal prices are $375 now, $150 a year ago, they're going, they're going, they're going,
That's all right, you can say that.
Yeah, thank you. They're going, holy shit, we need to do something about it, right? So in the long run, oil and gas, we need to understand that it's a finite resource. A lot of countries have no energy security over it. So for me, it makes sense to create a renewable, reliable, energy secure solution, which I think at the moment hasn't been managed globally by anyone well. I don't see one country who has managed the energy transition well, and I think it's biting us at the moment, and oil and gas is making a lot of money. But in the long run, as I said, you have to assume that these industries will and should be in decline.
And yeah, because they all have to be part of the transition. Key driver, policy, as discussed. Any other questions? One last question.
Hi guys, I'm interested to hear whether you think the E, S or G, which one is more important when you're reviewing a company?
It depends on the company, and it depends on the industry.
So if you were thinking about, you're looking for an affordable housing investment and you're assessing those companies, what would you be looking for?
That's not particularly within our remit because we don't do on the impact side of things.
Okay.
But if you were, to give you industry examples, if you were investing in, a manufacturing process, a manufacturing plant, right, often need a lot of energy and some of them need a lot of water. Okay, so in that situation, we'd probably assume that the E becomes incredibly important because if they're using natural waterways, what's the risk of polluting? Okay, if they have a run-on chemicals or whatever and it gets into the water system, what happens to that business? They will face enormous fines and it will cost them, right? If we look at something like a technology company, potentially we probably see more on the S. Like are staff being well enough looked after? Is this remote working thing happening?
Cybersecurity.
So it's kind of depends on the industry.
Yeah, that is a good question. And just to touch on how we would do it in-house, if a company has really good social practices and governance practices and highly engaged, very transparent disclosures, including their emissions profile, but they're not really in in an energy sector, or in the E, the E is not a big deal for them, we would still be scoring the E, but we'd give them more of a, neutral score if they're operating in quite a minimally harmful, didn't really have harmful environmental impacts, But for example, a calyx, that would score a lot higher than that because they're actually providing a solution that is helping the environment. But we do score all equally. And engagement's actually the largest piece of how we score because, as we said, that's probably where we see the most opportunities, things that are in the unknown.
Thank you all very, very much for listening.
Yeah, thank you very much. And for the great questions as well.
Equity Live! I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.